Hello everyone, we'll be starting now. So first of all, let me thank you every one of you who have joined today for your time. Today, I promise you that we'll be having a very interesting session. Today we have with us Mr. Viraj Gandhi. He's an MBA in Capital Markets from NMIMS. He started his career as a research analyst in BFSI sector in ICICI Bank as well as Ask Group. He has a vast experience in the markets as well as marketing, as you know he used to take weekly and daily calls for all the customers and was very great at solving customer queries when it came to the markets. So Viraj bhai is someone who understands the markets really well. You gets the nerve of the market really well. So I hope you get to learn a lot of insights today and create a win-win situation for all your clients as well as yourself. So over to you, Viraj bhai.
Thank you, Paras. Let me share my screen. Is it visible now?
Yes.
So, guys, thank you very much for your time and effort to give us an opportunity to present ourselves. The theme for today will be how to be better than an average investor. Just to begin with, this is a standard disclosure that is required, that anything that I'm going to share during the course of this particular presentation will be solely for the purpose of just giving you an example. There are no stock recommendation. We are not advising anything to be bought, anything to be sold on this particular presentation. If I'm taking any example, it is solely for purpose of passing on the information in a particular way, not against any particular script. So let me just take you through the flashback of 2008. We had one of the biggest IPO of one of the times during 2008, and we all know what an average investor did at that point of time. So in our office we normally call him a Ramu, but वो रामू ने 2008 में क्या किया था? He bought a particular script at the highs of 2008, okay, during this particular level. Until now it is languishing somewhere over here. Now this is what an average investor does. और हमको ऐसा लगता है कि after 2008 this should have been corrected, but 14 years later we saw similar such instance with one of the scripts again, where we saw highs at around this levels, and this is where the stock is today. Now this is what typically happens when the euphoria has been created in the market. And when such euphoria has been created, it is very important to understand what is the pulse of the market, what is the current state in which the market is. Until the time we do not understand the pulse, it will be very difficult for us to be better than an average investor. Now, an average investor makes only a 2% CAGR return. This is a very big study done by JP Morgan Asset Management Company for the past 25 odd years. And it shows that the returns of an average investor is less than 2% CAGR, where a normal S&P 500 would have given us 6% odd CAGR compared to a 10% by rate. Now, the idea of this particular call and this particular presentation is to make sure that we reach from here to somewhere here. And for that, we need to identify the reasons why this all happened. What are the factors leading to all this thing, and what we can do to avoid all this thing. That will be the course of the presentation that I will take you through. So let us understand actually what all happens. So we see that most of the time that a normal investor comes when the euphoria has been created, and it typically goes and buys at the top. And when then the market starts correcting, he starts exiting the market. So greed and fear plays at its role. At the top, you will see a lot of FOMO effect, a lot of greed, and a lot of investors will start coming into the market. And when the market starts correcting, they will start exiting. Ideally, it should be the reverse. Now, there are a few data points which I will show it to you, which will suggest that this typically happens throughout the lifestyle of an investor. This is the chart of Nifty 500 from 2002 to 2008. If you see this particular rally when Nifty went up by 3 to 4x, the volumes did not go up. But typically during the course of the action, when it was about to form its top in 2008, this is the kind of action that we have seen in terms of volumes. So typically all the investors started coming in during this period. And then we saw the correction in the market. If we see what happened post 2018, 2009, this is a leading newspaper publishing this particular phenomena, that 5 lakh SIPs were closed down in 2009. And that is why the bottoms were created. The net sales of mutual fund industry during those time, during 2008, you can see where it all reached. And during the period of 2009, when the bottom was created, the volumes typically dried up. If you could have done the reverse of it, then the investor would have made a lot of money. But typically what we are trying to say is the investor top pe aa raha hai, he's coming right at the top of the market and he's exiting right at the bottom of the market. Now we need to make sure, now this is a data that we have compiled from NSE. This data is not available outside, which shows that the unique PAN numbers in India typically was closer to 50 odd lakhs, went up all the way up by 2.5x in the euphoria of 2020 during the lockdown from 20 to 2022. And this is where again the tops were being formed by the market. And this is the kind of correction that we have seen in the market. Now, when a particular investor comes at the top of the market, and we have seen and we have heard this phenomena many of the time, that you spend a lot of time in the market and don't try to time the market. Even after spending 5 years from 2020, whether it's the fall of 2000, whether it's the fall of 2008, the global financial crisis, or during the top of 2018, if somebody is still investing and holding the stock for the next 5 years, the average CAGR return for that particular investor is less than 4.5%. And this is where he has a bad experience in the market. He goes out and he talks to all his relatives, friends, कि market में पैसा बनता नहीं है. This is not the place to make money. This is where typically people lose a lot of money. And that is why we see this kind of people again exiting the market. So in simpler words, what am I trying to say through all these slides is that if we would have invested at the top, be it in 2000, be it in 2008, or be it in 2018, 19, 20 top, okay, the average CAGR return would have been less than even a bond yield, which is less than 6%. So we need to avoid this particular thing. And particularly in this time frame, because in the last 40 years, what we have seen that every decadal returns, the CAGR return for every decade from 1980 to 1990 to 2000 to 2010 to 20, it's only going down. If you see this number, it's coming down from 21 odd percent CAGR return to all the way up to 9%. And it is anybody's guess where are we headed from here on. Are we headed back to 25% or will be closer to 10 to 12%? So making a mistake at this moment of time will be even more lethal than it was before. So typically what we are saying is that out of all this thing, we understand that the major challenge of the market is not to get the timing, is to make sure that we don't time it horribly wrong. Meaning, if we end up buying a particular stock at its top, then the CAGR return for the next 5 years, 10 years will be very, very, very minuscule. So we need to avoid that thing. So if I have to give you the example of a cricket match, that there are balls where we could have taken we could have taken an evasive action and we could have saved our wicket. So similarly in markets, there are levels in which we need to avoid buying. And there are levels in the market in which it's like a free hit. कि अगर उसमें मारेंगे तो out नहीं होंगे. If I try to hit that particular free hit, then it's only the runs that will be accumulated and the wicket cannot be lost. So similarly in markets also, we need to understand whether this levels of the market, ये छोड़ने का time है, or this levels of the market is the time when to go aggressive in the market in terms of buying the stock. There is a very famous saying from Sir Daniel Kahneman that the average investor return is significantly lower than the market indices, primarily due to wrong timing. So what we are saying is, just in cricket, we say that timing the ball is very important. We are saying in stock market, not making it wrong, meaning mistiming the market is what we need to avoid. So it is better said than done, but it is even followed by the biggest of the investors and the biggest of the names that we all follow, Mr. Sir Warren Buffett, that he also does the same thing, that when the market starts going down, see his cash levels. These are his quarterly cash levels that is been depicted in the blue. And this is the S&P 500 chart. When the market starts correcting, his cash levels also starts going up. And when the market starts trending up, his cash level starts going up, meaning it is very visible is if you see this particular chart that when the market starts trending up, his cash levels are going up. He is also trying to make sure that he's trying to buy the shares only when it is typically available at a very, very attractive valuation, and it avoids this buying range when the markets are trending up. So we also feel that we also need to do the same. Now, the next question that comes to in our mind, that if I have to buy stocks at a lower level, will it be available at a lower level or not? So this chart, which I'm showing to you on the screen right now, which shows that you take any major index in the world, be it Sensex, be it Dow Jones, be it Hang Seng, you take any major index of the world, on an average, 30 to 33% of the time it stays below its 200-day moving average. These are 20-year data, guys, that we have compiled, meaning it gives you a lot of time to accumulate stocks that you want to buy. So 1/3 of the time it stays below 200-day moving average, and 2/3 of the time it remains above 200-day moving average. So what we are saying through this slide is that we need to identify these times, we need to understand this time, and this is the time typically we go more aggressive in the markets, and that is where the alpha can be generated. But what is the biggest enemy when markets are correcting? When markets are going down, the thoughts that come to in our head is because the markets have gone for a doldrum, ye band ho jayega, ye chalega nahi. And that is the time fear takes over. A lot of narratives around are always negative during that period of time, and our emotions come into the picture. And that is the biggest enemy for an investor who wants to be an above average investor. So we need to identify the solution in which there are no emotions. So if we take that emotions out of the equation, that is the solution that we are looking out for. And how do we do that? We can only do that by three simple letters, which is margin of safety. Like if I'm driving a car and the margin of safety is low, if this car takes a break, agar usne brake maar diya, there are chances that I will go and bang that particular car and my health will be impacted. Similarly, if the margin of safety is higher, even if something happens to this car and it takes a break in between, which is not normal, still I will have a lot of room, a lot of roadway to make sure that I am not banged and my wicket is being saved. Similarly, in the market, it is very important to understand at what margin of level we go and buy a particular script, and at what margin of level we try to avoid buying that particular script. So let me introduce to you for the first time Semco's very own proprietary indicator, which is going to be its very own equity margin of safety index, which we call as EMOSI, equity margin of safety index. Now what this index is going to do, it is going to show us a range where it will be anywhere between 1 to 200. When the markets are trending up and the valuations are expensive, EMOSI will be low. That means what we are typically telling people is that at this level, you try to invest cautiously or very, very less levels. When the markets are coming down, when it is correcting and when the valuation starts becoming attractive, the value of EMOSI will be higher and upwards of 120, 130, 140. I will take you through the presentation in the next slides. And that is the level where we go aggressive in the market. Now, when we do this, it is easier said than done. When we do this, you will see something of this sort in terms of the market reaction. So this is the chart of EMOSI index, which we have created internally, which is our very own proprietary model. These are the 5 zones in which the EMOSI will be showing you all the indications. Now, the green zone are the one where we need to go aggressive in the market. And the red zone, that zone which is typically over here below 60, 70 levels, this level, this is where we need to be cautious in the market. So these are the 5 zones in which EMOSI will give us the indicator. Now let me show you by plotting the Nifty chart along with this. So if I plot the Nifty chart, which is black in color, if you see typically whenever there is a correction in the market, EMOSI goes very high. So what we are saying is whenever, so the EMOSI is a number between 1 to 200, okay, 100 being the fair value. Whenever you see the EMOSI number, the index showing anything above 100, more than above 120, 130, 140, these levels, anything above this level, this is the time to go aggressive in the markets. If you see this level, above 120 level. And if EMOSI is showing you any number below 80, below 70, below 60, any number which is in this end between 60 and 80, this is where it's like a cricket ball mein jisko yorker bolte hain. We need to leave it or we need to play it in such a way that our wicket doesn't go. So typically in this market, what we are saying is whenever you see a major correction in the market and you see EMOSI index going up, that is the time to go aggressive in the market. And what have we built? How have we built this particular EMOSI is very interesting. And this is where we are different than any other margin of safety index which is available in the market today. Is most of the margin of safety index that you see in the market today, I have all these fundamental factors, which is price to equity, price to book, market cap to GDP, bond yields. We also have these factors, but what we have done is we have incorporated a lot of technical factors also, like volatility index, moving average divergences, standard deviation, put call ratio. ये सब मिलाकर we have formed one index. So it's a combination of fundamental and technical both. When we do that, this is the output. If you see this particular chart, if you have bought at any EMOC levels of below 100, this level, the Nifty CAGR return for the next 3 years and 5 years. So this blue chart is a CAGR return for the next 3 years for Nifty for the past 20 years. And this orange chart is a 5-year CAGR return for Nifty. If we try to buy Nifty stocks at a low EMOC levels, then the next 3 to 5 year CAGR return cannot be higher than 10 to 12% for the past 20 years. But if we wait for the correction to come and try to buy at a higher EMOC levels and upward of 100, if you see any number of about this, then the average CAGR return that an investor can expect from Nifty particular stocks is above of 20-25% and can go all the way up to 50-55% CAGR also if we try to wait for the market correction and do not buy at a higher tops. This is actually the prescription that we are saying for people, that you wait for the correction and buy lower and do not try to buy higher. But we are adding one more phenomena to it. So let's say if a particular person is investing a particular amount in a liquid fund or an overnight fund and use it for the purpose of STP. So a normal guy would have done 1 lakh rupee of STP if it is. So let's take this example. So let's say if you have put 12 lakh rupees in a source fund और 12 महीने में divide किया होता 1 lakh each. So typically every month 1 lakh rupee would have been invested, whatever level of Nifty it would be or the market would be. Or a much safer way would have been to choose a 36-month STP. So spread it over 3 years. और फिर हर महीने 33,333 rupees would have gone invested into the market, whatever may be the market level. So what we are suggesting through our particular indicator is that we will use something called as timer STP. So keep the same 12 lakh rupees in the source fund. Rather than choosing a normal STP of 12 months or 36 months, we are advising people to use it better and use a timer STP. Now, what will timer STP do is that it will look at the EMOC level for that particular day. If the EMOC level is higher, it will put a higher than the actual amount that you have that you are going to invest. And if the EMOC levels are lower, it will invest very, very aggressively or very, very low level. So let me give an example. So let's say if somebody is putting 12 lakh rupees in a source fund and today the EMOC index is showing 100, for example, of the day of investment, then timer STP, if the base amount was 1 lakh, would invest only 1 lakh rupees. Let's say on that day, for hypothetically, that the EMOC level is 70. If the amount is 7, then the base number was 1 lakh, then timer STP would invest only 1,000 rupees and not 1 lakh rupees. And if the EMOC is upward of 140, 150, let's say today that EMOC on that same number, the EMOC is 150, then rather than investing 1 lakh on that day, it will invest 6 lakhs. So the variance of investment would be anywhere between 0.1 to 6x. So the benefit of doing this is like any other index, it would be that your rupee cost would be averaged. So because you're buying at all levels, because that will help you do a lot of compounding. The power of compounding will also be available. There will be no stress on continuous tracking the market because it is happening on its own. There is a lot of objectivity into it. Like there is no need for any subjectivity. And it requires to take away the emotions of a human being, which is where the human bias will be taken out and the risk return will be very, very high. So this is the EMOC chart which I was explaining to a timer. This is how the timer STP will take the multiple. So any number below 100, it will invest less than its base value. Any number above 100, it will invest more than its base value. It can go all the way up to 6x, meaning if the base value was 1 lakh, it can go all the way up to 6 lakhs. If I have to give you one example of how it actually behaved during the 2020 lockdown period, of let's say if somebody would have given me 12 lakh rupees in January and would have selected a timer STP, then in January the EMOC value was 94 So a 0.7 multiplier, meaning out of 1 lakh, only 70,000 would have been invested, and this would be the remaining amount. Similarly, in February, because the emoji number just kept increasing, the multiplier also kept increasing, and it invested 1 lakh in February, 6 lakhs in March, 3 lakh odd in April, and all the balance amount got invested during the May. So it got all the 12 lakhs got invested in the first 5 months itself. And what is the value of that 12 lakh rupees as on July 31st is closer to 22 lakh 44,000 compared to a 36-month STP of closer to 16 lakhs. So this is the kind of alpha that can be generated for a very simple reason. You're buying more when it is coming down, and you're trying to buy very, very less when it is at the tops. This is the chart which shows that the multiplier effect has worked in this particular fashion for the past 20 years. There were many, many instances that we have gone 6x into the market when the market was correcting. And there were periods in which, when the markets were trending up, where we have typically avoided our investment pattern because of the indicator which is in place. When we apply this particular concept on a Nifty 500 or a Nifty 50 from a 12-month or a 36-month STP, the average CAGR return from a timer STP has a potential of giving you a 5 to 6% alpha. A 5 to 6% alpha over a 12-month and a 36-month STP, which is very, very huge. It's phenomenal. And if you similarly check these levels for Nifty 50, it is also closer to 5% over a 12-month and a 36-month STP. Again, a 12-month and a 36-month STP also generates a lot of money. It's a best way of making money, which is what market has done over a period of time. What we are saying is that we have one more product. So there is a better way of doing it, is something called as timer STP, through which we can generate even a better alpha of 5 to 6% over a 12-month or a 36-month STP. Now, this STP also allows us to handle the emotions of the client better. Why? Very simply put, क्योंकि हम ऊपर माल ही नहीं ले रहे, so the drawdown of this particular index will be lower than a normal 12-month or a 36-month STP. Because we are not buying shares at the higher level, the drawdown of a timer STP is closer to only 7% compared to even 54% for a 12-month STP or a 26% for a 36-month STP. Now, this is what we are saying, that if we want to handle the emotions of the client better, this is one of the better ways of doing it. Let me give you a couple of scenarios how it would have invested its money during the global financial crisis and also during the COVID lockdown. So let me take the example of 2008 first. So let's say if somebody would have given me 12 lakh rupees for a 12-month STP, 1 lakh base amount would have been invested over the next 12 months, whatever may be the market levels. And similarly, a 36-month STP, this would have been the investment levels, whatever may be the market level. Now, in both the scenarios, an investor would have made money, but the same money, the same 12 lakh rupees, if we could have invested prudently during the fall of the market of 2008, when Nifty actually fell down by more than 30-40%, the investment would have been completed in the first 4 to 5 months. Now, this would have resulted, if we would have holding this particular stock, this would have resulted in a normal STP or a 12-month STP CAGR return of between 16 to 18%. But due to timer STP, where we have bought majority of the share at the lower level, the timer STP would have generated a 32% CAGR over a 12 and 36-month CAGR return of 16 to 17%, which is huge. Similarly, in the COVID crisis, if somebody would have given me the same 12 lakh rupees and it would have been used through a timer STP, the investment would have been done in this particular fashion in the first 4 to 6 months itself. And the timer STP would have generated a 29% CAGR return compared to only a 19 or 18% CAGR return compared to a 12-month and a 36-month STP respectively. Guys, this alpha is huge. This is a very, very big alpha if we would take in a short period of time. Now, the other question now that comes to our mind is that should we use this particular prescription and how do we use it? If we use this particular prescription and allow the Nifty to rally, and if we would have invested this particular amount for a longer period of time, the absolute amount in a timer STP, that 12 lakh rupees that would have been invested in 2006-8, the first instance that I showed you. And if you would have invested till now, the amount today in that Nifty names would have been closer to 80 lakh rupees compared to a 46, 47 lakh kind of a return for a 12-month STP. So it's virtually double, guys. So in the short term, it looks only a 3 to 5% alpha, but in the long run, the absolute amount actually doubles. So what is our promise to our investor? Our promise to all of you is that we are going to make this EMOC number live on my website on a daily basis. So today also it is live. So if you go on my website, semcomf.com, and if you just scroll it down, there will be a link for EMOC. If you click on it, it will show you a number between 1 to 200 every day night around 9 p.m. So rather than just keeping it with us so that only we can use this particular number, we are making sure that we display it on the website on a daily basis. It can be used as a tool for anybody to understand that what his rationale should be to invest in the market at this particular level of market. So this is our promise. As you all know, Semco Mutual Fund, the promise from us that we will always be transparent, we will always be available, and we will always be available on the website in terms of every product that we are disclosing, and that will, so that everybody can use it, be it an investor, be it a distributor, for their own particular benefit. So let me introduce to you today, for the first time we are introducing. So my first introduction was to make you understand the concept of EMOC and timer STP. But to do that particular thing, we need a source fund. We need a parking fund. So today we are launching. So tomorrow it's beginnings, my NFO, to launch our overnight fund, which will be beginning tomorrow. It will be open for the next 3 days. There is a one bank holiday in between. So technically it is open for 2 working days on 4th and 6th. The allotment of the same will be done on 12th of October. It will be reopened for subscription on 14th, and the benchmark will be CRISIL Overnight Fund. The investment objective is very, very clear, to make sure that there is a reasonable amount of safety available for a one-day maturity product, which will mostly be investing in TREPS, which has been issued by central and state government. This is very important to understand that for a normal STP, that you can select both the options from this particular scheme. You can select a normal STP also, you can select a timer STP also. The difference is, for a normal STP, you can select a daily, weekly, and fortnight, quarterly. All options are available for a normal STP. But for timer STP, you only have a weekly, monthly, and quarterly option. So you can select a weekly option, a monthly option, or quarterly option for timer STP. For a normal STP of 12 months, 36 months, all the options are available. Now, for a timer STP to be selected, you need a minimum amount of 25,000 in the source fund. There is no such restriction on normal STP, but for a timer STP, you need a 25,000 to be kept in the source fund at the time of registration. And there will be no exit load on the same. This is the form. I'll take you through the maximized version of it. So if you see this particular form, the only thing you need to select is whether you want to go for a normal STP or timer STP. If you are selecting a timer STP, you select whether you want a weekly option or a monthly option. If you want a weekly option, just select the day on which you want the timer STP to be done. And if you are selecting a monthly option, just select the date of the month on which you want the STP to be done. And if you are selecting a start date for a timer STP, our advice would be not to select an end date. The end date will be taken, it will be automatically taken as 2099, because जब वो market गिरेगा तभी वो पैसा लगाएगा. So we don't know at what level the market will correct. So it is basically what we are advising client is to select a start date and keep the end date open. And that is what you need to do. So very simply put, you need to select whether you want to go for a normal STP or a timer STP. For a normal STP, all the STP options are available. For the timer STP, you can select either a weekly plan, a monthly plan, or a quarterly plan. If you are selecting a weekly plan, select the day. If you are selecting the monthly plan, select the date. As simple as that. And everything will be done Objectively, it will, the systems are there in place, the systems will do it, and there is no need for any emotions of any particular individual in this. To select the TSTP applications, you have two particular two forms of doing it. Either you take the physical form, take the printout, the form which I showed you just now, this one, you can put all the details over here on the form, or you can go to Semco Mutual Fund website, my website, just click on to semcomf.com, log in there, take the amount. So you will be able to do it if the distributor is there. So just he will have to make sure that वो अपना login कर दे, उसमें उसको amount दिखेगा, and then you will be able to fill in the same details online also. So it's very simple, 3 to 4 clicks and it will be done. And that's it from our side, guys. We have three more individuals to be introduced to you, the people behind this particular thing. So there will be Viraj Gandhi as your CEO of Semco Mutual Fund. There will be Umesh Kumar Mehta, who is our Chief Investment Officer, and Dhaval Danani, who is the dedicated fund manager for our Semco Overnight Fund. So that's it from my side, guys. Just to sum it up as to what we said so far, there is a better way of making money in the market is to wait for the right time to enter the market and to understand what is the time we need to avoid buying into the market. For doing that, there is an index which is now been created by Semco, which is we call as EMOSI, Equity Margin of Safety Index, which will be flashed on the website on a daily basis around 9 p.m. Any number above 100 is the level to start accumulating more and more into the market. Any number below 100, meaning you have to go slower in terms of buying into the market and wait for the market to give you a better buying opportunity. There is a better way of timing the market through timer STP, where it will give you alpha over a normal STP of 12 months and 36 months. For that, we are launching our source fund, which is overnight fund, which will be beginning tomorrow. And these are the people who are going to be behind it, who are going to be working and who will be making sure that the systems are in place and it is functioning for the betterment of everyone over here. Thank you very much, guys. Thank you once again for your opportunity, for your patient hearing. If there are any more questions, I'm happy to answer this. Paras, over to you.
Thank you, Viraj bhai. I hope everyone got to learn something new today. You know, all of us, we hear that generally a lot of people in India abuse markets, that market is a gambling place. They try to stay away from the markets, and one or other time they've burned their hands in the market. So I hope you all got to know why that happens today. The main reason, as Viraj bhai clearly told us, that is emotions. And with EMOSI as our indicator, we've taken out the emotions out of the investment process. And again, it helps us and investors to not invest at a horribly wrong time, leading to very, very bad returns. So I hope you all got to get some really great insights from this session. We have few questions, Viraj bhai. Let's answer them. The first question is, what is, so I think 3 or 4 people have asked us, what is today's EMOSI? So today's EMOSI is around 103. It's available on our website. If you go to the footnote of the website, you'll be able to find a section called EMOSI. I'll put the link in the chat box where you can refer the EMOSI value. One more question is, if we follow EMOSI level, what are you suggesting here, that should we stop the SIPs during low EMOSI times or not?
Guys, let me clarify this particular thing. EMOSI level is not to stop you from investing. What we are saying is you can go aggressive at certain levels, you have to go defensive at certain levels. So let's say let's understand STP and SIP in two different buckets. When you have money in your bank, you park the money in an overnight fund and you can use it wisely when the market is trending up and trending down. This is for STP, for people who have money in bank. Typically for SIP, it is for people who right now do not have money in bank, but as their earning comes over a period of time and they save a little bit of money and they start investing into the market over a period of time. So if you have a choice of going aggressive on your SIP during the higher EMOSI levels, then you should do one. But we are not suggesting you to stop SIP because of the EMOSI level. But if you have a choice to invest aggressively when EMOSI levels are higher, when markets are correcting, then you should actually go for a higher SIP amount, is what we are saying.
Okay, thank you. Next question is from Mr. K. Murli. Where does the STP will be deployed? That was not covered in the presentation. Is it large cap or multi cap?
It will be deployed in our FlexiCap fund, which is the fund which is live today. The composition of my FlexiCap today is somewhere close to 55 to 60% is large cap, and the balance is mid cap and small cap. Out of which, out of the 40%, the balance amount, 10% particularly is small cap, and 30% is still mid cap in Semco FlexiCap fund. So I'm telling you the category as on 1st of September 2022.
Okay. Next question is, we do look at emosi when we transfer the money to target scheme. Do we pull back money from target scheme when the emosi is extremely low?
So guys, just one disclosure. We are not telling you to short the market or take out money from the market. What we are saying is stay invested in the market when the markets are trending up from what the fund that you have currently. What we are saying is when it is trending up, when it is closer, when the margin of safety is lower, do not deploy more money. Enjoy what you have. What we are saying is do not take out the money because market can stay expensive for a longer period of time. We are not saying that because it is expensive, it will come down immediately. During that period, you don't need to deploy more, is what we are saying. You can stay invested with the money that you have, because what we have understood for a long period of time, if you would have seen the Nifty chart, if you have stayed in the market for the next 3 years, 5 years, 10 years, you would have typically gone a higher level for the market. So rather than selling it and then bringing it down and again buying it, do not try to trade into using this particular language and using this particular indicator. We are saying use it wisely to invest at a particular level and use it wisely to invest even more aggressive at a particular level of market.
Okay. Next question we have is on, sir, taxation. How does taxation fit into the STP part?
Same, the taxation remains the same. There is nothing changes as per the taxation. Taxation आप जिस दिन खरीदते हो ना उस दिन से apply होता है. So guys, just understand, this is just an indicator. अगर आप गाड़ी चला रहे हो ना तो गाड़ी लेने का और बेचने का मार्केट का काम है. ये जो हमने आपको बताया ये सिर्फ एक सिग्नल है. Where to go aggressive in terms of driving, where to stop in terms of driving, where to be cautious in terms of driving. This is not the car. What I just showed you in terms of emosi and timer STP, it is only an indicator कि आपको गाड़ी कितना पेस पे चलाना चाहिए, कब चलाना चाहिए, नहीं चलाना चाहिए, रुकना चाहिए, ठहरना चाहिए, भागना चाहिए. So this is an indicator. Taxation applies from the day you buy the stock and everything remains the same for you. Just use the indicator to buy it wisely is what we are saying.
Okay. One more question is, do we decide the date of STP or the customers have to, decide the date of STP?
It is on you. It is on you to decide the day of STP. We cannot decide. Paras, if it is your money, you have to decide for it. And that's why I said you will have to select whether you want to go for a weekly STP or a monthly STP as per your requirement. If you have selected a weekly, just select the day. If you have selected the monthly, just select the date of the month. But
Okay.
you will have to select it if you are the investor.
Okay. I think that's it. There are no more questions. If there are any more questions, please do let us know in the Q&A box. We'll be more than happy to answer.
After this also, guys, if you have any more questions, feel free to reach out to us through our mails and we'll be happy to answer them also. Yes, Paras, go ahead.
One more question is, can we invest in this through Rank MF app?
You can.
Okay. What is advisable? Is it monthly or weekly STP is advisable?
Our back-tested data shows that if you select a monthly one, it will be better. But if you want to eat each and every volatility of the market, then go for weekly. See guys, understand, ऐसा नहीं होता है कि मार्केट एक महीने में गिरा और एक महीने में 20% मार्केट गिरा और उसी महीने में चल गया. It gives you enough. So if you understand the slide which I showed you, 32% of the time Nifty stays below 200 moving average. So in a monthly STP also, a lot of volatility will be taken into effect. But if you still want to be part of each and every data point, then choose a weekly one. But Ideally, we would advise anybody to go for a monthly STP.
Sir, next question is NFO available on BSE Star?
Yes, overnight fund will be available on BSE Star. For for doing a timer STP, you will have to either do it through the physical form or through the website route of Semco MF. But for overnight fund, you can go to BSE Star and take that particular NFO there.
Okay. One more question is, what happens when STP is disabled? I'm not sure if I get this question right.
STP is disabled. Can you elaborate?
I think probably what is meant is if the STP is not successful, for how long will it be active, if I'm not wrong? I think the period is 5 months, if I'm not wrong. So for 5 months, if the STP if the fund, there is no funds in overnight fund, then the STP will be disabled after 5 months of not hitting it.
So let me answer you differently. What I've understood is you are asking me that if I've given you 100 rupees, it is all, and I have chosen 12-month timer STP, but because the market was in corrective phase, it got invested in the first 5 months. So now there is no fund in the source fund. So typically it will wait for another 5 to 6 months before it closes down. If I have understood the question correctly, Paras, but I understand what he's asking is कि अगर वो source fund में पैसा नहीं है तो timer STP कब बंद हो जाए? But the major question is, whosoever has asked this question is, कि if your fund is invested in the market, you don't have to worry for it. कि वो कब चल रहा है कि बंद हो गया? Because the fund is already invested. Only तब भी बंद हो सकता है ना? If there are funds in your account in the overnight fund, तो वो बंद ही नहीं हो सकता. It is only possible if the entire fund is allocated already before the stipulated time.
Okay. What will be the maximum duration of STP? How much time I need to park funds?
So as I told you, if you are selecting timer STP, just select the start date and keep the end date open. वो अपने आप हो जाएगा. But if you are selecting a 12-month STP, choose a 12-month period. If you are selecting a 36-month normal STP, choose a 36-month and divide it by 36 installments. But if you are selecting a timer STP, just select the start date and keep the end date open.
Okay. If the date is first of each month, when money is credited in target scheme, when will be the money credited in target scheme? So I think the answer to this question is the money will be credited on the next day because it takes
T+1.
Yeah.
So guys, every rule of STP applies here also. I'm just telling you there is a better indicator, nothing else.
I think we have a query from 2-3 people. Can you please explain the EMOC part again? I think few of them have missed it.
So what we are saying is that Semco has built its own proprietary model using fundamental and technical aspect, which will tell you कि AA level पे market क्या लगता है. What is the market showing you at this level? So let's say today we are closer to 17,000 Nifty. So what is it showing at 17,000 Nifty? So how do we understand fundamentally and technically what is the market, how our market plays as on today? So what EMOC will do, it will flash a number between 1 to 200 using this fundamental and technical parameters, and it will be flashed every day night. So let's say yesterday the number was 103, meaning it is showing that at this level, markets have started to look attractive. So rather than putting 1 lakh rupee through your normal base amount of STP, it will advise you to put higher than 1 lakh rupees. I hope this example is clear.
So I think it should be clear. Can you change the day or date of timer STP once registered?
Is the question that if I have to change the date of the monthly STP, is it possible or not?
Yeah. So as far as I remember, the modification is not allowed once
Not allowed.
Yeah, not allowed. So if the STP is registered already.
Guys, once registered, it will be difficult. I think you will have to change the.
Yeah, so
You
you'll
will
have
have
to
to. Yeah, you
cancel
will have to
the,
cancel it and do a
yeah,
fresh one.
correct. So I think that's it, Viraj bhai.
Thank you very much, guys. Appreciate all your effort and gratitude for giving your time and effort to hear us out. Looking forward to your participation for the overnight fund, which is opening tomorrow, so that you and me both can work together, and the systems are in place to work it together to have a better than an average investor's return by timing the market correctly. Thank you very much. Looking forward.
Thank you, everyone. Bye.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.